Introduction to Normal Distribution and its applications in financial risk management. So the primary objective of this session is, as we discussed, broadly outline what is a normal distribution, why does it get applied in financial services, and how do I actually interpret the entire idea of looking at a normal distribution and inferring information out of it, right? That's what we're going to do. That's what we're going to look at. Basics first. Let's understand the importance of risk and its measurement in finance. So primary tools to measure risk in finance are derived from statistics. Standard deviation is the most commonly used tool, right? So most of the spaces that we see in terms of risk, we use this term called standard deviation. There are some other things that are also used, things like mean absolute deviation, for example, and there are other derivations from the standard deviation or variance bit which are used to arrive at various forms and measures of risk, but primarily standard deviation is the most commonly used metric across asset classes, across financial services firms in order to measure and quantify risk, right? Now that begs us a question, what is it essentially? So what exactly is the standard deviation? I'm sure a lot of us would know about it. So it's a deviation from the expected value either side, right? Let's take an example to understand. I commonly take a very simple example back home. If you have let's say two players in cricket like Dravid and Sehwag, and both of them score, let's say Dravid scores 50, 50, 50 and 50 over the course of 4 innings, and Sehwag scores 0, 100, 0, 100 over the course of 4 innings, the average in both the cases is going to be 50, correct? 200 divided by 4 in both the cases. The challenge, however, is that you realize that this is far more consistent than this. And if you want someone to play for your life, that would be Dravid. If you want someone to give you a lot of entertainment, that would be Sehwag in this case, right? Now, the objective of this is to understand that there's an expected value, which is the average. How much does each guy vary from that? So the first guy doesn't vary at all. There's no variance. He scores exactly what is expected of him every time. The second guy varies an amount equal to the average, right? So 50 up or 50 down is what comes up. And this deviation from the actual expected value is what is effectively quantified as risk and what is known as standard deviation. Right? So broadly, that's how we quantify in finance as well. If you want to save something for your retirement, you want something with very little standard deviation. If you want to maximize your wealth building, then you want something which has a lot of standard deviation. You want action in the investment essentially, right? So that's how finance works. Now that brings us to the next question in this entire discussion, which is, when you're talking from a finance perspective, specifically, why both upside and downside? Standard deviation gives you a movement both sides of the mean, right? So if the mean is expected to be 10%, then standard deviation is either side of the mean. So why do we take both sides? Why not only the downside risk? Because most people would look at, if I expected to make 20% in a stock and I ended up making 30% in that stock, that's great. What's wrong with that, right? Now, there are 3 broad reasons for that, why standard deviation makes sense as such. The first one is essentially that short selling is allowed in financial markets, which means you can buy later and sell earlier. So you sell something first, let's say you sell at 100, and then you buy at a future price, which is, let's say, at expected to fall to 80. So you're planning to sell something at 100 and buy at 80, which gives you a profit of 20. In this case, if the price goes up after you have sold it at 100, you're in trouble. So you make losses. The second reason is there could be opportunity loss. Let's say I expect to make 20% in a stock. I buy the stock at 100, sell at 120. Now the stock goes up to 150. That's an upside risk. That's an upside risk, correct? Now, practically when there is an upside risk, there is an opportunity loss that comes up. The third reason why an upside risk is still a risk is any unexpected movement is termed as risk. Now, that doesn't necessarily mean that risk is in a negative connotation at all points of time. In society, we treat risk as a negative connotation, object or parameter. But in finance, risk could actually work in your favor, and hence any unexpected movement, either direction, is primarily termed as risk, and that's why you rely on something like standard deviation as your measure, and you continue using standard deviation in your overall discussions around finance and the calculations. Fine, so that's where standard deviation comes in. That's a critical part of our overall understanding of the normal distribution. Fine. Now we move on to the next topic, which is around normal distribution. What is it? So let's take up the definition of normal distribution first. I've picked it up from Wikipedia. It's named Gaussian distribution after the guy who derived it or found it or named it rather in 1809. In probability theory, the normal or Gaussian distribution is a very commonly occurring continuous probability distribution. So there are a few key elements here which we would want to probably also underline as we read. It's assumed to be a continuous probability distribution, a function that tells the probability that any real observation will fall between two real limits or real numbers as the curve starts tending towards zero or approaching zero on either side. They are extremely important in statistics and are commonly used in natural social sciences for real valued random variables whose distributions are not known. Right? So now we'll come to all this. This is obviously a textbook definition of what normal distribution is. The key words for us are it is assumed to be a continuous probability distribution, and typically we try and find out two limits or real numbers between which a certain value will lie based on a certain probability, right? It also says that the function tends to zero on both sides as you go along. So it starts falling, the number of observations start falling to zero as you go along, right? That's your broad connotation of what you mean by the normal distribution. Let's understand and take this further and look at it diagrammatically or graphically. What does it look like? So that's typically how a normal distribution would look like. Let's understand and explain the importance of this first. The center line, vertical line that you see is typically your mean value. It's assumed that that's your expected value. That's the central value. That is also the value that you expect to occur the maximum number of times. So in simple sense, if you were to take a class full of 200 students and you're looking at their heights being plotted on a distribution, typically you will find that most of them would center around a certain average, and then people will either have more a higher frame or a lower or a smaller frame based on how they move ahead. So typically if you can say that 6 feet is what comes here, that's the maximum number of occurrence. People with 6 feet 5 inches would be lesser than people with 7 feet will be even lesser, and so on and so forth on this side as well. 5 feet 5 inches and maybe 5 feet would be even lower, and so on and so forth as it goes along, correct? So the middle point is the average expected value, that's the mean. That is also the value that is the most expected value. So it's also what is commonly known as mode in statistics. This is the value that you expect to occur the most number of times in a certain distribution. The distribution could be of anything, correct? It could be, for all you know, the number of goals scored by Messi over a period of time, or multiple seasons as you go, correct? Now that's one that comes up. The second point is it's symmetrical in nature. So the curve is absolutely symmetrical, or at least closely symmetrical in nature, which means the number of observations on the right side and the number of observations on the left side of this mean are equal, right? Which means this value also becomes the median. It is not only the mean, it is also the median. So a normal distribution has a scenario where your mean is equal to your median, which is equal to your mode. That's the standard understanding. Now a normal distribution also gets completely described by its mean and its variance, which is the standard deviation in a nutshell. Effectively, standard deviation is the square root of variance essentially, right? Now how do we interpret it? Couple of other things before we go ahead to understand this curve is, if you look at the lines, effectively that's your mean value, and you move the mean value by a little bit. You add something here and you subtract something on this side. And as you keep adding and subtracting, you're looking at effectively this scale, the vertical scale, is nothing but the number of occurrences of the event. Correct? So effectively you expect the maximum number of occurrences of the mean, then the values keep falling as you go along, and eventually it will fall very close to 0. Correct? Now you could add or subtract any values. You could add or subtract whatever, if the mean is 15, you can add 2 on either side and continue adding or subtracting till the time you reach close to 0 values. Or typically you start doing what? You start adding the standard deviation. So you take mean plus standard deviation, and you take mean minus standard deviation, and then you add another standard deviation, and then you subtract another standard deviation, and that goes on, right? So effectively you create a curve that represents on both sides deviations away from the mean. So this is your mean. You add plus standard deviation to arrive at this point. Then you add another standard deviation to arrive at this point. Then you add another standard deviation to arrive at this point. Subtract standard deviation, subtract standard deviation, subtract standard deviation, and you arrive at these 3 points. It's a symmetrical curve. It's a curve which is centered around the mean, and it's a curve that becomes kind of 0 closer to the tails. As you go towards extremes, it becomes closer to the tail. Simple examples of this would be, for example, a lot of the B schools today in the world have a normalizing of the marks, so normal distribution of marks being given to people, where there's an average that is created, there's a percentile system that is created, and everyone bases their numbers based on the top guy. So if the topper has scored 80, that's considered 100, and then you kind of scale it down. And you have typically everyone in the class has a distribution of their marks based on this normal curve. So if the average score is 60, you will find maximum number of people around 60. Logically, some people will have lesser score, some people will have a higher score, right? And you will have the number of people who have lesser and higher scores. This will keep getting smaller and smaller as you go along. Fine. Now, how much smaller and how much further are you going is kind of defined in a normal distribution. So we don't need to worry about it. We would have read about it. So let's quickly understand. That's the standard normal distribution curve. It's defined by its mean and variance. Now, roughly what happens is effectively what we are saying, that you have your +1 standard. These are standard deviations, right? So this is a standard deviation. This is a standard deviation. And on either side you're moving. So we keep adding standard deviations on either side as we go along, and as we keep adding standard deviations, the curve plateaus out. Now, in terms of a standard normal curve, what is defined is that between these 2 points, which is your +1 sigma and -1 sigma, pardon my drawing, this portion, you have roughly 68% of the observations that you are totally looking at. Then if you look at +2 sigma and -2 sigma, that number becomes 95%. So if you're looking at 100 observations, 95 will lie between these two ranges, correct? If you're looking at 100 observations, 99 will lie between -3 sigma and +3 sigma as you go along. So as you keep increasing the width of this curve, you have more and more observations that start falling between that bracket. That's what a normal distribution says, right? So that's where the normal distribution's understanding is. We'll just remember these numbers, and obviously some other numbers are easily deductible. It's symmetrical in nature. So effectively, if you're saying 95% is between these two values, 95% is between these two values, we are talking about 2.5% on the right of this and 2.5% on the left of this, correct? Similarly, it's 50% above the mean and typically 50% below the mean, right? That's the standard definition of what a normal curve is. Now, we're not really worried about the definition of a normal curve because that exists, but the question is, in reality, do we actually see this, right? So why normal distribution in the first place? Now, why not anything else? Why only normal distribution that comes in? Now, there's something called as the central limit theorem, which is coming to the rescue of almost everyone who does any sort of market research or sampling or data collection and data analysis, is that if you take any population, any kind of population, and you have any probability distribution, as long as it has a mean which is finite, defined clearly as a mean, a real number, and it has a finite calculable variance. You can calculate the variance. If you take a sample from this particular population and the size of the sample is large, so what is important is that the size is large. Now textbooks define this large as greater than 30, greater than 50, but for simple assumptions, let's assume a large number. We're not even worried about what the small size is. Take a large enough sample. Now this sample is assumed to be approximately normally distributed. This distribution of the sample and the mean of the sample is assumed to be approximately normal. That has been seen across distributions regardless of what is the distribution of the population. The sample that you draw out of it, as long as it is a large enough sample and it is a random sample, it is assumed to be a normal distribution, and because of that you can apply normal distribution on practically everything where you have a finite variance and you have a defined mu that has been given to you. Fine. So effectively based on these, we are kind of going ahead and deriving this number and going ahead and calculating a normal distribution and using a normal distribution in our calculations. Now the next question that comes to our head is then, this must show us in some sort of inference. It's all good to say that we are using normal distribution and we're going to use it in our calculations, and we're going to stick by whatever rules the normal distribution says. But it is completely another thing to say that it actually confirms, right? So let's test it. That's an important part. Now, let's understand the first premise, which is the use of it in finance. Now, typically, returns from stocks are assumed to be normally distributed. If you want the exact technical definition, the change in the logarithm of stock prices is assumed to be normally distributed. So you take the stock price, you take the natural log of it, and then you find the difference on day one, stock price on 1, and you find the log of stock price on day 2, you find the difference. This change is technically assumed to be normally distributed. Right? Now we don't need to get into this technicality. What we'll assume, very simply put, is that returns from the stocks, which is change in the stock price on a daily basis rather than log of, change in the log of stock prices. We are saying change in the stock price. Let's see if that is normally distributed. And even if it is partially normally distributed, we can go ahead and use our assumptions to kind of extend this in terms of a little bit of risk management, right? So let's test this if it holds in reality. And if we get the same kind of numbers and concepts that we have seen, or at least close to what we are looking at in terms of normal distribution, we're getting something similar to that when we actually try and deal with normal distribution and look at a few stocks. So let's take two indices. We take S&P 500 and Nifty. Nifty is the Nifty 50 Indian NSE exchange stock index, and S&P 500 is the US market stocking index. We are now trying to see if normal distribution holds at least approximately or not in these conditions, right? So let's actually try it out. Let's look at normal distribution. What you see on the screen is an Excel file that you have. Now this Excel file has data on the Nifty starting from 4th of January rather, 2010. First was a holiday and then followed by a weekend, and then you have the Nifty data that is given to you till 12th of September, which was yesterday, right? Now let's try and see. Remember, returns are normally distributed, so I need to find the return. How do I find daily returns? So my daily return is nothing but my today's price minus yesterday's price divided by yesterday's price, change divided by the previous price. In other words, today by yesterday minus 1. That's what this formula would give me effectively. So we'll solve for this. Let's put this number here. That's today by yesterday minus 1. That's my return today for Nifty. And I will just double click this and it should calculate everything for me. Now we have daily returns of Nifty for the last 4.5 years or so, right? There are some data points which are already put in this Excel file, and I'll give this to you at some point of time. The total count of the numbers that we have is 1189, right? So 1189 days of returns is what we have. That's our total sample size. Let's try and find the average. So we can find the average using a standard formula called average, and we calculate the average of this entire set, which is close to 0%. In fact, let's add a couple of decimal points to this. When we add a couple of decimal points, we get 0.043% as the average of the Nifty returns over this period. That's the average expected return over this period, right? Let's look at standard deviation. So standard deviation is STDEV, and we quickly calculate the standard deviation of this data, which comes at 1.1%, right? So now we know that this is the standard deviation given to us. This is the average given to us. Effectively, our assumption needs to hold true on multiple counts. One, we need to check if it is symmetrical. Two, we need to check if the ranges hold, which means that 95% and 68% and 99% essentially kind of holds. And three, we need to look at the broad shape of the distribution. Does it look like it's a bell-shaped curve? You have to look at all these three things, right? So let's first take them one by one. Let's understand the symmetrical point as we go along, right? So what do we have here? We have 1189 observations. What is put here is counted if the values are greater than the mean and counted if the values are lesser than the mean. So you find that this value is greater than mean, number of days count, and this is lesser than mean approximately, right? Now when you look at this data, you find roughly 580 days have been greater than the mean and about 609 days have been lesser than the mean. In a span of about 4.5 years, there have been about 12-13 days that are effectively pushing this on one side rather than the other. Can we ignore it? Possibly yes, but let's see. I mean, it looks broadly symmetrical because on 580 days it has been above the mean and 609 days it has been below the mean, and half of it would have been what, 594, 595. So if on 15 days instead of being lesser than the mean it had been greater than the mean, then we would have had our scenario working fine, right? That's the first part. Looks broadly symmetrical. Let's understand the ranges part. So we need to create the ranges. So here what we do is we take the mean and we add plus minus 1 standard deviation. So this is mean plus 1 standard deviation, plus 2 standard deviation, plus 3 standard deviation. That's mean minus 1 standard deviation, minus 2 SD, minus 3 SD. And I plot all of this here. And let's try and arrive at some sort of a frequency distribution that gives us where these numbers are, right? How many numbers are between certain ranges, and there is a function in Excel that allows us to do so, but we can actually count as well. So technically all we need to do is count if a value is above something and below something and work with that. But we're trying to find ranges of this distribution, right? There's a function that solves this for us. So we will quickly apply that function and see how it works. So we'll use this function called frequency, correct? Now, when you look at frequency, it has two data points. One is called a data array, the other is called a bins array. Data array is the point which effectively talks about what is the set of data that we are looking at. So what is our data array? That's the returns set of data that is there. I take this and I freeze it, and then I put a comma and go and look at the bins array. So where is my bins array? That's going to be here. Bins array is the range that I'm looking at. So we are going to look at this range. That's my bins array, and I'll freeze it and I'll close the bracket and I'll put an enter. Right now when I put this enter here, it doesn't solve the problem as yet. We'll solve the problem in a second. So now this frequency function is an array formula which is beyond the scope of this discussion. I'll explain that separately. But remember, we have to form buckets of this data, and because we need less than minus 3 standard deviation, between 2 and 3, minus 2 and minus 3, between minus 1 and minus 2, and above 3 standard deviations, we have this set of data, but there will be one extra range that will get created. So if 5 is the number of occurrences less than 3.1 minus 3.18% over the last period, I need to get the number of occurrences greater than 3.27, which will come here. So do one thing, we select this. Once you select this, there's a little bit of roundabout that needs to happen. You've selected this. Now we go and click on the bar where we have done the formula calculation, and we do a control plus shift plus enter. What do? We do control shift enter, right? This is an array function. It returns multiple values in one shot. So what did we do? We did control plus shift plus enter instead of doing just enter, and we selected this entire set, and then we pressed control shift enter, so it calculated it across the domain. Right now, what does it show? It basically shows that there are 5 values which are less than 3 standard deviation, and if I'm looking at this range, which is between 0 and 1 standard deviation, which is the mean, and 1 standard deviation, which is this value, that's effectively 135 items between these two sets. Right? That's what we get based on this particular function that we have seen, and what we have looked at. Now, this file will be sent to you, so don't worry in terms of how to use it beyond the point. You can use it at a later point of time. I'll email the file to you guys. Now, if you look at the numbers that are outside 3 standard deviations, so which are the numbers outside 3 standard deviations? This is outside 3 standard deviation, 5. And outside 3 standard deviations, that's 7. Correct? So above 3.27%, we have 7 values, and below minus 3.18%, we have 5 values, combines to give us 12, which is approximately 1% of our total count that we had, approximately 1% of our total count, which means 1% of the values lie outside your plus and minus 3 standard deviations. Correct? If I add this plus this plus this and this, 27 plus 7, and these two values, 5 plus 25, that's effectively the range outside 2 standard deviations, right? So minus 2 onwards on the left side and plus 2 onwards on the right side, we have 64 values out of 1189, which accounts for roughly 5.4% of the values outside 2 standard deviations. Correct? Looks to be in confirmation with what a normal curve says. Now, outside 1 standard deviation, we see roughly about 27.8% or 28% values. This doesn't directly confirm. This looks like it's not exactly the same. But broadly, what we have identified is that in our normal curve, beyond, let's say this was the mean, and we have 1, 2, 3, and we have 1, 2, 3, 3 and minus 3. Beyond this, we were anyway saying it is, 99% lies between this. That's what this shows. So it confirms. We said between plus and minus 2, 95% lies approximately here. We see outside this we have 5%. So that also gets confirmed. We said between these two we have 68% approximately here, and hence 32% outside. We found that instead of 68 we have 72, minor change, but still looks like broadly symmetrical, confirms to the ranges as well, and is broadly symmetrical even across. So we have 27 here, we have 25 here, we have 5 here, we have 7 here, and so on and so forth. So broadly confirms the symmetrical nature even across the breadth of the curve. It's not just on one point or on extremes that is happening, right? We can actually plot a chart, and once we plot a chart, the solution of this is given to us. So all I need to do is I select all these 8 data points, and I go and click insert, and I click, let's say, a histogram chart here. That's my chart that I get, right? So that's the chart that we see. Right now, so that's the observation that we have gotten from Nifty. It seems to be normally distributed. It seems to be symmetrical, and it seems to be confirming to the ranges as well, essentially, right? So these 2-3 things we have kind of identified, and they seem to be logically working with at least Nifty. Let's look at our answers for S&P as well. So we have the top curve is S&P 500. Same analysis when we did on S&P 500. What did we find? We found that the mean was 0.05%, which was approximately similar to your Nifty values. We also found that the standard deviation was slightly lower, so you have lower ranges. 3% negative becomes 3 sigma and 3.1% positive becomes 3 sigma. And you have similar curves as you see for S&P 500 that we just saw for Nifty. What we saw for Nifty has already been plotted here as a normal distribution number, right? So it looks fine. But does this seem familiar? In principle, it looks to be what we had seen, but all we need to do is rotate both these curves anti-clockwise, 90 degrees. So that's what we do. So we just rotated them anti-clockwise and by 90 degrees. And what we find is a frequency distribution that in both the cases broadly resembles your normal distribution, right? So we're right. It kind of shows that approximately it does hold normality on these distributions, and that makes sense in terms of our overall understanding of what we are being taught in terms of returns in finance and all the applications that play out there. So this is over last 4.5 years of data. You can use various points of data and try and work this, but usually at least approximate normality does get exhibited on wider scales and on most stock returns that you take. We'll look at one more just to understand and gauge the importance. So we have established that normal distribution seems to be appearing in the returns of stocks. So let's extend this further in the concept of understanding how do we look at essentially understanding this in the context of risk, right? I have a few questions that have come, but I'll probably take them towards the end, so kindly hold on to them. Let's infer this. So now we have this Nifty histogram that we created. We had this entire understanding, and let's understand how a simple risk management application or tool can be built on this. Let's assume we are a trader in Nifty and we invest 100,000 every day in Nifty, or we trade with 100,000 every day in Nifty, and we do this day in, day out, every day for the next 1,000 days, right? Now, interestingly, given this entire set of data where we have exact number of movements over this period, we are saying that if normal distribution works, there should be approximately 10 days, which is plus 1 sigma, 1% of this entire set, where the returns are greater or lesser than 3 sigma on either side, 3 standard deviations, either more than 3.28 or less than 3.19%. Now it quantifies the entire set of understanding that effectively how much money can I make or lose on an average day. It's expected that I'll make 0.04% on an average day. It is also expected that I will lose on 10 days out of these 1,000 days. I will either make more than 3.28 or lose more than 3.19% kind of a number as we go along. We can also quantify the loss. With a 99% certainty, we can say that the return would be between minus 3 sigma and plus 3 sigma. So that also kind of gets quantified. Now, there are multiple inferences that you can extend out of this, which is it would also mean that in 97.5% cases, remember, because of the symmetrical nature of the curve, and let's actually draw that to understand that better. We have a symmetrical curve like this, and we have, let's say, these points where we are identifying. This is the mean, this is plus 2 sigma, this is minus 2 sigma. Now our minus 2 sigma is minus 2.11%, right? We are saying 95% of the times the value will lie here. 2.5 is on the upside. Now if you're a trader and who's trading on the long side, this 2.5% should be good for you. It shouldn't be bad. You are worried about this portion, which is 2.5% once again. So out of your 1,000 days, 25 days is expected to be in this portion where your return is less than minus 2.11%, but at least 975 days you will not lose more than 2111. correct? That is the maximum loss you can have, is because that's 2.11% of your 100,000 that you have established. Max loss in 97.5% of the cases will be 2.11% as you have expected, correct? Now remember, this is empirical data, what is known as empirical probability calculation, and it is not necessary this holds in future. Most of these characteristics on risk management are kind of, they have a disadvantage, which is that data that you have used is primarily historical in nature. So it assumes that your sigma does not change. If your volatility changes, the band becomes wider and then the loss could be higher. So it does not tell you that tomorrow the loss cannot be 10% or 15%. That can always happen. It just says that if the current conditions prevail and you do the same trade for 1000 days, what is the kind of profile of returns that you will make? Now this has significant advantages in terms of running a portfolio, that on usual, normal, business as usual days, how much money will you lose? What is the probability of losing that money, which gets extended into something commonly known as value at risk. The value at risk concept that gets derived from here, where you have a probability distribution and you know how much money you can lose on a day-to-day basis, and with a certain probability you are identifying it. So with a 99% certainty you are saying something. That doesn't mean the loss cannot be 20% or 25% or 40% on any given day. Such events occur, but on a normal business as usual kind of a day, you will have this kind of a profile working. That's how this gets applied. That's how this gets deployed in the conventional sense of how you apply this. Now there's another way of understanding this, is let's say we compare. So let's go and take another stock. We have something called as Jaiprakash Associates, JP Associates, which is a infra cement power company listed in India, right? Again, you see the distribution of Jaiprakash Associates looks to be approximate normal. That's what we have. Just that the standard deviation that you calculate is about 3.7%. If you remember, this number for Nifty was about close to 1.1%. Now what is the impact of the standard deviation being 3.7%? 1 sigma itself is a wider band than your 3 sigma that you saw for Nifty. Remember, Nifty 3 sigma is 3.19% and 3.28% either side. But for Jaiprakash Associates, given its higher volatility, your 1 sigma comes here. And obviously the number of values that are outside 1 sigma are these and these. So your chances of getting numbers which are wide beyond your range expected become significantly higher. Now let's explain this more in terms of actual numbers. Now if with JP Associates I go and trade with 100,000 on for 1,000 days, there will be at least 25 days, again 2.5%, where on this 2.5% here, where my losses will be greater than 2 standard deviation. Where is that 2 standard deviation number? That's 7.45%. So there will be at least 25 days on a 1,000 day basis where this number would get plotted here. Now remember, for Jaiprakash Associates I've taken last 2 years data. This is 2 years data, and hence you see smaller numbers here, but as a proportion it still remains the same. You saw normality being exhibited here as well. Just that when you create this pattern, if you trade for 1,000 days, remember our loss in Nifty was 2111, and you only expect more than 2111 kind of a loss on 25 days. Here that number becomes a loss of 7450 on 25 days, correct? And that's how you quantify whether you want to put an investment in a stock with a higher standard deviation or a lower standard deviation. Make no mistake, this works the other side as well, which means returns greater than 7.31% is 7310, greater than profits greater than this will also occur about 25 days. Right? So make no mistake, this works both sides. But if you're someone who doesn't want a heart attack in terms of your investments in finance, then you would probably go for Nifty as against a JP Associates. But if you're someone who wants to trade aggressively and you're willing to take that volatility and risk, that is how it effectively gets defined. That is how it effectively gets computed and given out to someone. Remember, this all exists in terms of probabilities and it is being worked on historical volatility. So it is not foolproof. It assumes that the volatility you have seen in the past will stay. If that doesn't stay and tomorrow morning there is a news item or the company loses a case or something of that sort happens, obviously volatility is going to change. And if that changes, the parameters may not exhibit in the future what they have exhibited in the past. That unfortunately is the reality. We have to live with that and work with that. We don't have a roundabout way of dealing with it. But that's basically how you go and quantify and use a normal distribution and a normality scenario in terms of basics of financial risk management. Now this can obviously get built over significantly. There are multiple things you can do with this. A lot of other things that typically get done using normal distributions are sampling, where you have picked up data on a particular, what we did was a kind of sampling essentially. You have hypothesis testing essentially, where let's say you pick up data for a company's inventory days or receivable days across clients, and you're trying to assume that this receivable days data is normally distributed. And then you're trying to figure out whether or not it lies in a certain range or it has gone out of a certain range. So that comes in terms of hypothesis testing. We just saw what value at risk comes in terms of our discussions. And finally, in terms of entire your Black-Scholes option pricing premise is based on normality and normal distribution of stock price returns, sorry. And that's what gets built up in terms of other applications of normal distributions and how the risk management bit gets built up. So that's broadly what I had in my mind in terms of discussion on normal distributions and their initial application in terms of risk management in finance. Obviously the topic is huge and is beyond the scope to cover more than this in a small session, but it's a start. Hopefully it should help you in terms of going and looking at more data points as you go along. Fine. So that's where we close the session today.